Welcome to Pie Uncut, where we break down the biggest stories in tech and the stock market in a way that actually makes sense. Today's story is one of the most surprising developments in the market right now. Nvidia, yes, the same Nvidia that led the AI boom, is suddenly being called cheaper than the S&P 500. That sounds almost impossible. For years, Nvidia was considered one of the most expensive stocks in the world. Investors were willing to pay a premium because it was at the center of the AI revolution. But now, something has changed. And this shift could be one of the most important signals for investors in 2026. Let's break it down in simple terms. First, what does cheaper than the S&P 500 actually mean? It doesn't mean Nvidia's stock price is lower than the index. It means Nvidia's valuation is lower. Specifically, we are talking about something called the price-to-earnings ratio, or PE ratio. This ratio tells us how much investors are willing to pay for every dollar of a company's earnings. Right now, Nvidia is trading at a forward PE ratio of around 19.7. while the S&P 500 average is around 20.3. That means investors are paying less for Nvidia's future earnings than they are for the average company in the market. And that is extremely unusual, because Nvidia is not an average company. It is one of the fastest growing companies in the world. Let's understand why this is happening. The first reason is simple. The stock has fallen. Nvidia is down this year, with its price dropping significantly from recent highs. And when stock prices fall, but earnings remain strong, the valuation automatically becomes cheaper. But here's the interesting part. Nvidia's business is not slowing down. In fact, it is still growing at an incredible pace. The company recently reported massive revenue growth, over 70% year over year in some periods. That's not normal. Most companies in the S&P 500 grow at single-digit rates. So now we have a strange situation. A company growing at 50 to 70%, trading at a valuation similar to companies growing at 5 to 10%. This is what analysts are calling a valuation inversion. Now let's go deeper. Why would the market price Nvidia like an average company? The answer lies in sentiment. The market is shifting. For the past 2 years, AI stocks were unstoppable. Investors believed that AI would drive massive growth for companies like Nvidia, Microsoft, and others. And that belief pushed valuations to very high levels. But now, the narrative is changing. Investors are becoming more cautious. There are 3 main concerns. First, AI spending. Big tech companies are spending hundreds of billions of dollars on AI infrastructure. Data centers, chips, cloud systems, this is one of the largest investment cycles in history. But the returns are still uncertain. Second, macroeconomic pressure. Interest rates are still high. Geopolitical tensions are rising. And when uncertainty increases, investors move away from high-growth stocks. Third, expectations. Nvidia has already delivered incredible growth. Now the market is asking a tougher question. Can this growth continue, or will it slow down? And that brings us to a critical point. Nvidia's future depends on a small number of customers. A large portion of its revenue comes from major cloud companies. If even 1 or 2 of these companies reduce spending, Nvidia's growth could slow significantly. So while the opportunity is massive, the risk is also concentrated. Now let's zoom out and look at the bigger picture. What we are seeing is not just about Nvidia. It's about the entire tech sector. For years, investors paid a premium for growth. Now they are demanding proof. They want to see real profits, not just future potential. And this is creating opportunities. Because when sentiment shifts, stocks can become disconnected from fundamentals. That's exactly what may be happening with Nvidia. Despite strong earnings and dominant market position, the stock is being priced more conservatively. Some analysts even say Nvidia is now trading at 16 times future earnings estimates, far below its historical average. That suggests the market may be underestimating its long-term potential. But here's the key question. Is Nvidia truly cheap, or is the market telling us something important? Let's look at both sides. The bullish case is straightforward. Nvidia is the backbone of the AI economy. Its chips power everything from data centers to generative AI models. The demand for computing power is exploding, and Nvidia is at the center of it all. If AI continues to grow as expected, Nvidia's earnings could keep rising for years. And if that happens, today's valuation could look like a bargain. Now let's look at the risks. AI demand could slow down. Big tech companies could reduce spending. Competition could increase from companies like AMD and custom chip developers. And regulatory pressures could impact global semiconductor supply chains. In other words, the future is not guaranteed. And that's why the market is cautious. Now let's bring this back to investors. What does this mean for you? First, it shows how quickly market narratives can change. A stock that was once considered expensive can suddenly become cheap. Second, it highlights the importance of valuation. Even the best companies can become risky if they're overpriced, and conversely, even great companies can become opportunities when sentiment turns negative. And third, it reminds us that investing is not just about growth. It's about the balance between growth, risk, and price. Right now, Nvidia sits at that intersection. A high-growth company with a more reasonable valuation in a market that is becoming more selective. So the big question, is this a buying opportunity or a warning sign? The answer depends on your perspective. If you believe in the long-term future of AI, Nvidia could be one of the most important companies of the next decade. But if you believe growth will slow down and competition will rise, then caution may be justified. Either way, one thing is clear. The AI trade is evolving, and Nvidia is at the center of that evolution. This is Pie Uncut, where we cut through the noise and bring you the story behind the numbers. If you found this useful, stay tuned, because the biggest shifts in the market are just getting started.